Did you know the only type of inheritance tax or death tax we have in Australia can be found when our superannuation is paid out on death to our non-financial beneficiaries? Welcome to Dollars and Dreams, the podcast designed to empower you to take control of your personal and business finance. You know, the very thought of money and finance can often send chills down your spine and stir up fear of the unknown. But let's change that narrative together. Through this podcast, my goal is to not only to provide you with useful information, but also to inspire and motivate you to take action towards your own financial goals. Let's rewrite your money story together. Welcome to today's episode of Dollars and Dreams. Today's episode, I want to have a bit of a chat around what is the only place in Australia that we have an inheritance tax or a death tax, and that's inside our superannuation funds when we die. And it's something that when I talk to a lot of my clients about putting a strategy in place to make sure that the taxman doesn't get part of their super when they die, people will say to me something along the lines of, who cares? It's not my money. I'm dead. Who cares? They're getting all my money anyway. They can pay some tax on it. But for most people, when it comes down to it, they really don't want to hand over money to the tax office that they don't have to. And of course, the other side of it is that you can leave quite a significant tax burden for your beneficiaries. And of course, there's some strategies that you can put in place to try and at least eliminate or minimise anyway this death tax that we have from our superannuation. So towards the end of today's podcast, I'll actually share with you that strategy that we do here for a lot of our clients to make sure that when they pass away, their beneficiaries are receiving their superannuation without a tax burden. And it's not only a tax burden from your superannuation coming to them, it can actually trigger taxes for your beneficiary from their own income, Centrelink benefits and things like that. So there is a significant cost to the beneficiary if you don't put this strategy in place to minimise what the tax office get. So, of course, with superannuation, as we know, there's lots of terms that are not easy to understand. So I'm going to demystify a couple of those terms today as well. So as I said, if you stick around to the end of this podcast, I'll give you a strategy that you can talk to your advisor about, or you can reach out to us here at jenrichardson.co. So the first thing that we need to understand is anything that is paid out of your superannuation after you've passed away is called a death benefit, so a super death benefit. So basically all that is it's just a term that's used to show the amount of money that is in your superannuation and what is being paid out to your beneficiaries. Of course, the one thing that a lot of clients that we work with don't really understand is that your superannuation is not covered off by your wishes under your will. They are under two different legislations here in Australia. So it is important that when you're considering where your superannuation is going to go, you can put it in your will that that's where your super goes, but you've got to do one little thing before it. So it is something that you need to consider. What we normally do in our superannuation funds is we do what is called a death benefit nomination. So a death benefit nomination is telling the trustee of your super fund where you want your super to go. And of course, there's two different types of death benefit nominations. There's a binding death benefit nomination and a non-binding death nomination. Inside each of those, there's also a lapsing and a non-lapsing. So there are four little terms that I'm just going to go through now of what they are. So of course, a binding death nomination is exactly what it sounds. It is binding on the trustee of your superannuation fund to follow your wishes, even though they may not be in the best interest of your assets and the distribution of them. It does mean that as long as the binding death nomination is valid, it has to be applied and followed by the trustee. Now, you might be thinking to yourself, well, why would I do a binding death nomination and not want it followed? But with a binding death nomination, particularly if it's a non-lapsing is something that continues until you physically change it. A lapsing death nomination is one that has a time period, so you'd have to re-nominate that one. And some of the reasons that we do a non-lapsing is because most of us aren't great at keeping up to date with updating our records and things. So let's say your marriage breaks down, that's whether it's legal or a de facto marriage, and you've put your partner down to receive 100% of your superannuation if you were to pass away. Now, let's say you've done that and you do pass away and you still are legally married to that partner. Your super is going to go to your ex-partner and not to the new beneficiaries that you would want to receive your superannuation. So some of the super funds will recommend that you do put a lapsing nomination in place, just so that it reminds you every 3 years that you need to update that record. A non-lapsing means that it will stay in place until you actually jump in and change it. So let's go back to the binding one. So you've got your spouse, you've separated, but have had a binding nomination on there. That means that the trustee of the super fund will give that money to your estranged partner. It means that it won't go to your children or wherever else you would have probably preferred it to go. If you have what is called a non-binding death nomination, that means that the trustee of your superannuation will take into account what your wishes are, but doesn't have to follow them. So if we use that same circumstance that you've nominated your now estranged partner, if you've got a non-binding nomination on there, the trustee of your superannuation fund will actually then look at your circumstances and say you probably don't want it to go to your ex-partner, you would want it to go to your children. And so they would send it there potentially to your children rather than your ex-partner. So there's two different, as I said, the two different nominations. They are unique. I mean, I have mine as a binding death nomination, but I'm in an industry whereas if my husband and I separated, I would know to jump in and change that pretty quickly. If you're not one of those people, maybe a non-binding one is better for you. Do you have a lapsing or a non-lapsing? That would depend on, again, how good you are at updating your records and remembering to do that. Or, of course, if you've got a financial advisor that you're working with, that is something that they would check for you when they reviewed your investments in super at the end of each year. So two different circumstances, two different things. But the other thing that I want to talk about now is who can actually be a dependent under superannuation law. So there's two different laws that apply to superannuation. There's the superannuation law, which is the SIS Act, and there is the taxation law. So superannuation laws nominate who can be a beneficiary under superannuation regulations. And that comes into play for a lot of people if they've never been married, they don't have a partner, they don't have any children. And this is, people in their 20s. You still should nominate somebody to have your superannuation, regardless of how much it is. So who a beneficiary is under superannuation laws is your spouse, whether that be legally married or a de facto spouse, a child of any age, and a person in what is called an interdependency relationship. Now, an interdependency relationship is someone who has a close personal relationship with you and you are living together, and one or both of you provides financial support to each other, and one or both of you are in a domestic support or personal care relationship. Now, it's not you can satisfy one of those conditions, you have to satisfy all four. So an example of that would be, let's say I have a friend, so I don't have any dependents and I don't know who to leave it to. And I wanted to leave it to my friend who has some mental incapacity. Now, I can't just leave it to them unless we have a very close relationship, that we are living together, that I would be providing financial support, and I'd also be providing some care support. So my friend who has some mental incapacity lives in my house. I support them financially, so I pay their bills, I provide food and accommodation for them. We're in a very close relationship because we're living under the same roof. I also can demonstrate that I do their washing, ironing, cooking, cleaning, pay their bills, take them to medical appointments. That person would be classed as a beneficiary under superannuation laws because I am now in an interdependency relationship with them. Take those same circumstances and my friend can live independently. So they stay in their own home and all I do is I go and pick them up and take them to their medical appointments. I might go over and help clean their house for them. I might do their grocery shopping for them and drop it off to them. But because I wouldn't be providing financial support and they're not living in that same house as me, then they would unlikely be classed as a beneficiary. And so the question I get asked all the time when I talk to my young clients that don't have a husband or wife yet, they don't have any children, and I say to them, where are you going to nominate for your superannuation to go? And of course, they all look at me and say, my parents. My parents can have my superannuation because they're going to get everything else if I was to pass away because I have no one else to give it to. Or they might say, I'll give it to my niece and nephew because I'm going to leave all my money to them in the will. My parents don't need it. They're elderly. My nieces and nephews can have my money. Under superannuation law, your parents or your niece and nephew are not a beneficiary. So you can't leave your money in your superannuation. So what happens if you don't have a spouse, you don't have any children, you don't have anyone in an interdependency relationship? Who do you leave your superannuation to? In those circumstances, we would nominate your legal personal representative. So that is the executor of your will. The will then take your direction inside there that my superannuation, when you receive it, I want to go to my parents or I want it to go to my niece and nephew. And the executor of your will can then transfer your superannuation to where you wanted it to go. So it is a really important distinction that if you've nominated your legal personal representative to look after your super, you can get it to those people. You just can't get it through a death nomination form within your superannuation fund. The other thing, though, you can leave it that way and have it always dealt with under your will, or you can, when you get married, change your death nomination to be your spouse. So it's completely up to you. And there's some fors and against in both of those. So I'll go through those a little bit later. Dependents under tax law is a little bit more strict than a dependent under superannuation laws. So the superannuation laws determine where the money can go. The tax laws determine the tax consequences of that. So a dependent under tax laws is still your spouse, whether that's legal spouse or a de facto spouse. It is also a former spouse or a former de facto spouse. And of course, both of those can be of any sex. This is the key difference, I guess, is that a dependent child under tax laws must be under the age of 18 or be able to demonstrate that they are financially dependent on you. So if you have a child that has some incapacity, they will still be classed as a dependent under tax laws, provided you are completely supporting them. There's also the same superannuation laws that anybody who is in a interdependency relationship with you is also a tax beneficiary. So why is that important? And this is what today's episode is about, I guess, is that when you're looking at your superannuation coming out to your dependents, they need to be a dependent beneficiary under tax laws for that superannuation to come out tax-free. So let's say your spouse has predeceased you and you want to leave your money to your children, or you don't have a spouse and you want to leave it to your children, but they're all in their 40s or 50s or 30s. They're not a dependent under tax laws. They're a dependent under superannuation laws, but not a dependent under tax laws. So this is where the death tax comes into play. When you are paying out your superannuation, some or all of your superannuation may be taxed if your beneficiary isn't a dependent under tax laws. So I'll go through that a little bit more in a sec, but what I want to do is just explain the difference of why I said some or all of your superannuation may be taxed. So firstly, let's talk about the taxing when you're paying it to a spouse, whether that be a legal spouse or a de facto spouse, or you're paying it to your children who are under the age of 18. So the money will always come out of superannuation, or will mostly come out of superannuation. There is a couple of little catches, but I won't go into that today because that's quite complex. So we can make the assumption that for most of us, that superannuation will come out tax-free. And that's because in Australia, most of us have what is called a taxed super fund. If you have a non-tax super fund, that's where some or all of the money may not come out tax-free. Again, if you need advice on that or you're not quite sure whether you're in a taxed or an untaxed super fund, please get some personal advice from a financial advisor. And I guess, I'm pointing out here that this is general advice. It's not taking into account your own personal circumstances. And so it's just for your education so that you can ask the right questions, or so that you can at least think about what you need to do with your superannuation. So we're paying it out to our beneficiary, who is a spouse or a dependent under the age of 18. Mostly, as I said, that will come out tax-free. So it doesn't matter what the components of your superannuation fund are. But when you're paying that money to a non-dependent under tax laws, so that would be your children who are over the age of 18, there are some breakups inside the super fund that will determine whether you pay tax or not. So anything that has gone in tax-free, so that's what we call your non-concessional contribution. So remember, non-concessional contribution is an after-tax contribution into your superannuation fund. So that will always come out tax-free, whether that's to a non-dependent under tax laws or a dependent under tax laws. Then what's left is what we call taxed or untaxed. So most of us will be taxed because that's the contributions that we call concessional contributions. So they're your employer compulsory contributions or any contributions that you have put in that you have claimed a tax deduction. They're the two common ones. Now, when they come out to a non-financial beneficiary under tax laws, they will be part of your dependents or your beneficiaries' taxable income. They're taxed at 15% plus the 2% Medicare levy. And then you have what we call the untaxed. So that's usually is created by insurance premiums. So if you had a life insurance premium and your superannuation fund collected that on your death, that would be what we call an untaxed component of your superannuation. When that is paid out to a dependent under tax laws, it is tax-free. When it's paid out to a non-dependent under tax laws, that will be taxed at 30% plus Medicare. The reason that is because in your taxed component, you've already paid 15% inside the superannuation fund. You pay the other 15% when it comes out to your beneficiaries. But because the insurance premium's never been taxed inside the super fund, that's why your beneficiaries pay the 30% plus the 2% Medicare. So before your trustee pays the money out to your beneficiary, who is a non-financial dependent under tax laws, they will withhold that 15% or 30% plus the Medicare and pay it to the tax office. Your beneficiary will then get the balance. So using an example here, let's say I have 200,000. I'm going to use some nice simple numbers here, doing it in my head. Let's say I've got 200,000 in my superannuation fund. 100,000 is a tax-free because it's money I've put in as a non-concessional contribution, and 100,000 is taxed because that's what my employer or I have put in and claimed as a tax deduction. My husband has predeceased me, so my superannuation fund money is going to my children. They will receive the 100,000 completely tax-free because it is tax-free in the super fund because it's already been taxed in my own personal name, and I put that money in from my after-tax dollars. The 100,000 that is taxed will now come out to my children, but my trustee of my super fund will withhold 15% plus Medicare, which is currently 2%. So that is $17,000, which will go to the tax office. That means that $83,000 will go to my children of that 100,000. That is where, when I start talking to people, they go, hang on, why does the tax office get 17,000 or 17% of my super when I could have pulled it out and it would have been completely tax-free because I'm over the age of 60? That's the death tax that we have in Australia. So my children will get that $83,000. For simplicity for today's, let's say I've only got one child. They will then declare that as a super lump sum payment in their income tax return. Now, the complications come in for my beneficiary. Let's say my child that is going to receive this money has already a taxable income of $200,000. The $100,000 will come in as taxable income. They get the credit for the tax that's already been paid of $17,000. Now, all of a sudden, my beneficiary has a taxable income of $300,000. They are then going to have a Division 293 assessment on their superannuation. A Division 293 assessment is the way the tax office tax what they call high income earners. So as we know, our superannuation contributions are taxed at 15%. If you're a high income earner, and that is $250,000, including your taxable income, your fringe benefits, your negative investment losses. So if you've got a negatively geared rental property, that gets added back in. Your superannuation contributions come in on top of your taxable income, and it brings in any reportable superannuation contributions as well. So $250,000 is what the tax office call high income earners. Now, that means that once you become classed as a high income earner, your super contributions are now no longer taxed at 15%. They're taxed at 30%. So 15% inside the superannuation fund, and then you get a lovely assessment from the tax office and you have to pay that additional 15% super in your own name. You can apply to have your super fund release it, but it means that your superannuation balance is going down. So the contribution from your super fund coming out to your children, which would have been tax-free to you, is now taxed. But not only are you paying tax on that payout from superannuation, you've also potentially now got a Division 293 assessment for your beneficiary, as well as they may have to pay back any family tax benefits that they received or any Centrelink or Services Australia support that they have received. They may have to pay back child care rebates. They also may get caught with, if they don't have private health insurance, getting hit with the Medicare levy surcharge, or if they've got private health insurance, they may have received too big a rebate through the year and they'll have to pay back the rebate. So there's lots and lots of tax consequences for your beneficiary that is over and above the simple 17% tax that may be paid from your super fund. So when I start talking to my clients about this, all of a sudden that term that I said at the beginning that they say is, I don't care, I'm dead, doesn't bother me. They're getting all my money anyway, they can pay a bit of tax on it. All of a sudden, it's not 17% anymore. Potentially, it can be 30-35% tax that they're going to pay through having to pay back, the Division 293 or having to pay back family tax benefits or, getting hit with the Medicare levy surcharge. So there's lots of taxes over and above the tax that will be paid on your superannuation. That's why, when I'm talking to all of my clients, I say we need to put this strategy in place to convert your taxed component to an untaxed component. And again, I'll follow that off in a little bit. The only reason I'm putting that at the end is not to make you stay, although I'd love you to stay right to the end, but because there's a little bit more that I want to cover off on what happens with your super when it's paid out. So if you pay out, we've said that you're going to nominate your legal personal representative. So that's the executor under your estate. So we're doing that now instead of paying it to a beneficiary. Some people will say to me, yeah, that's great. Now I've avoided the tax because it's not going to a non-financial beneficiary. When it gets to your estate's still got to pay it out. So it still stays. The advantage of if you have non-financial beneficiaries under your estate is that if you pay it to your legal personal representative, they don't pay the 2% Medicare levy because an estate isn't an individual. So they still pay that 15% tax because the ultimate beneficiary is still a non-financial beneficiary under tax laws. So they'll still pay that 15%. They don't have to pay the 2% Medicare levy, and they don't get caught with the Division 293 assessment. So there is some benefits to paying it to your legal personal representative. However, that means that if your beneficiaries are maybe going through a divorce, maybe, separations on the cards, that money of you can be part of the family assets that need to get distributed. Whereas if it's paid directly to the beneficiary, depending on what they do with it, of course, once they receive it, nobody can put a claim on the super payment before it comes out. So that is a little bit different. But look, when it gets to your estate planning, there's 3 people that you need to talk to, and everybody should invest this money to talk to them. Your financial advisor, which can help you with getting your death nominations in place, but also your estate planning solicitor to get your estate planning set up. Because once it goes to your legal personal representative, there's lots of things that you can set up inside your estate to protect your money from people that have gambling or, blow the money. You want to make sure that they're going to get that money when they're responsible. You can protect money from divorce or separation or from being part of your own business and you go bankrupt. So there's lots of things, but only the legal advisor can do that for you. So you really do need to get yourself a great estate planning solicitor. If you don't have a family solicitor or you're not quite sure, because some solicitors don't do estate planning all that well or don't want to do it, if you don't have one, reach out to us here at jenrichardson.co. We've got a number of estate planning solicitors we can give you the names of, and of course then you can decide out of those ones which ones you want to see. We don't recommend one and one only because it is your choice and you need to be able to work with the person that you have done. Same thing with your financial advisor. If you don't have one of those, reach out to us here at jenrichardson.co because, of course, we've got financial advisors in my financial services business and we can help you out. And, of course, the other person you should talk to is your accountant because your accountant can talk to you about the tax consequences of what you're putting in place. So I did tease you a little bit at the beginning of this podcast to say I'll let you know on a strategy that we put in place for a lot of our clients so that they can avoid this death tax and avoid the on-flow of the consequences to your non-financial beneficiaries. So it's what we call a withdrawal and recontribution strategy. Now stick with me for a minute. I've got to go through a few more things so that you understand when you can do this. So what we do with a withdrawal and recontribution strategy is once you have met a condition of release from your superannuation fund, so that is if you're over the age of 60, remembering that from the 1st of July 2024, everybody will need to be 60 before they can get access to their superannuation. So from the 1st of July 2024, if you were born after the 1st of July 1964, you have access to your superannuation from the age of 60. So once you've reached the age of 60, remembering 60 to 65, to access your super, you must have retired or ceased working for somebody who has contributed to your superannuation. There's a little catch on that one. So again, get in touch with a financial advisor if you're still working but you've ceased your employment from somebody between the age of 60 and 65. So let's say we've reached the age of 65 and you can access your super at any point, regardless of whether you're working or not. So we have reached the age of 65, we would withdraw the super that we can, and then we would recontribute it as a non-concessional. Now, with your superannuation, you can't just say, I want to only withdraw my tax components. It's got to come out in the same percentages as your superannuation is sitting there. So if your superannuation is 50% tax, so from concessional contributions, and 50% untaxed from after-tax contributions or non-concessional contributions, it comes out in those proportions. So every dollar that you drag out will come out 50% tax, 50% untaxed. Now, it generally will be tax-free to you, so it doesn't really matter. But when you put the money back in, it becomes non-concessional. So the idea is that you should be withdrawing your superannuation if you can and recontributing back into your super as non-concessional. Now, we have lots of clients that will say, oh, I've got 10 years to live. I'll worry about that later on. There's caps for when you can recontribute to your super. So there is time limits that are involved. And also, you don't know what's around the corner. I have unfortunately had clients that have died in their 40s from cancer. I've got clients that have died in their 30s from cancer, and clients that have retired and then had a heart attack a couple of weeks later. So you don't know what is around the corner. So you need to prepare as though something is around the corner. Hopefully it never happens, but we are far better off to work on that something could happen. So if you can withdraw it and recontribute your money to super, you will turn it from taxed to untaxed. Again, I will stress this is just general advice, and it's to give you something to discuss with your financial advisor. You do need to get personalized advice on this. So if you have non-concessional contribution caps, at the moment as this podcast goes to air, the caps are 110,000 a year, and you can pull forward the next 2 years, so 330,000. But if you've exceeded those caps, you can't recontribute. So that's where you need to get some advice on how much can I pull out and recontribute. If you can't get it back into superannuation, it may not be the best strategy for you, because that money's going to sit outside the nicely concessional taxed component of superannuation. The caps from the 1st of July 2024 are going up to 120,000 a year. And again, you can pull forward 2 years, so you could put in 360,000 as a cap. The thing that you need to remember, if you've already pulled forward into the 25-26 year, which you may have done, you are stuck with that 110. You can't say, well, there's another 10,000 for the 25 year and another 10,000 for the 26 year, because when you've pulled forward contributions, they apply at the date that you pulled them forward. So the strategy then, if you pull it out, and let's say you haven't done any non-concessional contributions and you pull out 360,000 after the 1st of July 2024, you pull out $360,000 and you recontribute that 360,000, that money is now sitting in non-concessional or tax-free to your non-financial beneficiaries when you pass away. That will mean that you can't do anything for the 26 financial year and the 27 financial year, because on the 1st of July, you used your 25 financial year cap of 120, you've used your 26 financial year cap of 120, and you've used your 27 financial year cap. So there is a process in place. So then when we get to the 1st of July 2027, you can potentially pull out currently $360,000 again and recontribute it. So there is time limits, and if you've got a lot in superannuation, you've really got to stagger this to beat the best benefits. So that's the way that you can potentially make your superannuation to your non-financial beneficiaries tax-free. And it's a great little savings so that the taxman doesn't get your hard-earned money and it goes to the people that you want to have it, not to the people that are beneficiaries under our social security system or under the taxing system, or the politicians that, we all hear it, don't we? They get their grubby little hands on our money. So if you need some more information, because there is a lot to what we just talked about, reach out to us here at jenrichardson.co. I haven't got anything on our website yet, but if you have a look, maybe this will come up in some stages on our website there as a resource that you can look at. But of course, if you need more information, reach out to us here at jenrichardson.co. I would love if you liked and subscribed to our podcast so that you get the notifications when our podcasts go to air. We've also got our YouTube channel, which you can jump on and find more videos. So that's it for me today. I hope I didn't overwhelm you, but remember, this was about just a strategy that you can talk to your financial advisors about how to turn the tax office tax machine off your superannuation. So that's it. Hope you have a great week, and I will catch up with you all very soon. Thanks. Remember, the advice shared in Dollars and Dreams is general in nature and it does not consider your own personal circumstances. Dollars and Dreams is for educational purposes only and should not be relied upon to make investment or financial decisions. If you need more help, please reach out to a financial advisor for tailored personal advice. Don't forget to click that subscribe button so you don't miss out on future content. And please leave me a review. Your feedback really helps me to reach other people chasing their money dreams. You can find me over on Facebook and Instagram to connect with me. You will find the link in the bio or head over to my website at jenrichardson.co where you will find free content and learning tools.